All right, good evening, everyone. Once again, my name is Glenn Thomas. I'm the Reverse Mortgage Sales Manager. And tonight's training, we're going to talk about the HECM for purchase, better known as the reverse for purchase. The HECM for purchase is the tool that a lot of people are still not familiar with, but hopefully after this training, we're going to turn you into an expert in the field. Just to let you know, within like last 2 to 3 weeks, have closed 2 HECM for purchases. And both homeowners are very happy that they're now able to own a home and not have to make a mortgage payment, and also didn't have to deplete all their resources. So before we start, are there any questions from last week or any other questions you have or things that you're looking for in this training that you want me to answer for you? So if you have a question, please feel free to type it, and I'll address some of them now. All right, it doesn't look like we have any questions. All right, we're going to go through this. I'm going to show you how to enter the information into the reverse vision. We're actually going to work a deal together. All right, so no questions. Here we go. All right, we're going to talk about why buy a different home for retirement. What is a HECM reverse mortgage? The benefits of the HECM for purchase, eligibility factors, the borrower's responsibility, the loan process, and most important, why ERS? Because I'm here. All right, if you are over 60, if you are age 62 and older, have you considered buying a different home so you can live closer to family? Switch from a house to a condo. I like this one, right size your home. You might have had the home where you raised your family, big home. Now it's a little too big. Might be 2 stories, you might need a single level. Live in a neighborhood with easier access to amenities such as shopping, medical care, or recreation. Or this is one people don't really think about. You might be more comfortably able to afford some upgrades or a more expensive house versus if you're going to pay cash for it. So you can get into a $400,000 house with right around $200,000. So that would be a benefit for you to get that bigger house or more expensive house, but don't spend $400,000 cash on it. A reverse mortgage can help. There's no monthly mortgage payments for as long as you live in a home. Spend less of your savings, and you own a home with your name on the title. So just like any other mortgage, you own a home, and your name is on there. All right, this is an option that allows borrowers 62 or over to convert some of their equity into tax-free cash. So normally when people think of reverse mortgages, they think of it for an existing home. But you can actually use it for a new home. And just like I said, that's what we're going to really talk about. Still, no monthly mortgage payments are required. Remember, you still have to pay your taxes and insurance just like you normally would pay. You know, this was originally designed to help borrowers remain in their home. There's just so many facts that the longer, as we get older, if we stay in our current home, we tend to live longer versus if we have to relocate to an apartment or go somewhere else where you change your surroundings. So people tend to feel more comfortable in their long-standing homes. You know, most reverse mortgages are government insured, and that's where the HECM comes in. There are some that are not government insured. Those are normally the jumbo products. There's a couple of different companies out there that offer jumbos, and we do work with both of them. So if you have a borrower with a $2 million home, guess what? We can do a reverse mortgage on it. HECM for purchase. Now a HECM reverse mortgage can be used to buy a home. Instead of paying all cash or taking out a traditional loan, you can use a reverse mortgage. You know, if you're 70, you might not want to pay 30 years on a mortgage. That money can go towards other things. Here's the market. All right, according to a study by Reverse Mortgage Insight, about 6% of senior homeowners relocate annually, and 20 of them use mortgage financing. Okay, so we're going to take that 20. If just 20% of the people using finances use the HECM for purchase, that is 10,000 800 new loans annually. And many more buyers, they pay cash. So once again, they might be, like we talked about, they might be house rich and cash poor. So we take the numbers. 4.5 million seniors, and that number is growing every day. Relocation rate, 6%. Seniors who relocate every year, 270,000. 20% of them are using financing. So that's 54,000 new loans that are taken out by seniors. And like I said, a lot of them might be paying cash. So like I said, it's definitely a market out there for them. All right, this is one of the things that are really big now, the 55 plus communities. You know, they get the community atmosphere, you know, more mature buyers. More mature neighbors. You don't have to worry about the kids running around. You got a lot of social events. They're maintenance free because they take care of the front lawn for you. Real big, like I said, the two that we've done, both were in 55 plus communities. And that's one of the things that people are really looking for. They really like the fact that they can live in a community with people of their own age, and they have different things for them. They got the workout areas, they got the pools. You know, you got a lot of different activities. And the biggest thing, provision for the age and homeowners. So normally you're not going to have, you know, too many people 60 years old with a bunch of little kids running around. Normally their kids are, you know, grown, and now they're enjoying their senior life. So key thing, all borrowers must be 62. Okay, can't emphasize that enough. Everybody must be 62 or over.
The property must be paid off, right?
No, the property, for the purchase, you're paying it off when you go up front. So I'm going to get into an example of that, how that works for you. But, you know, like we talked about before, with a regular reverse mortgage, the home doesn't have to be paid off, okay? It can be, hey, can't have a mortgage on it. But as long as there's enough equity in there to do the reverse mortgage, we can do it. All right, benefits of the HECM for purchase. There's no monthly mortgage payment, so as long as you live in a home. So you can use that money for other things. Like I said, you can buy a $400,000 house with about 50% down. Okay, of course, you're still responsible for those household expenses. Property tax, insurance, homeowners association dues, anything like that. So once again, like I said, it can help because you're spending less money out of pocket. So the key thing, so if they want a more expensive home, they can get it without having to put all their money down. You know, like I said, they can afford upgrades. Key thing, we can't overemphasize this enough. You own the home with your name on the title. So my name isn't on the title, the bank name is on the title, their name is on there. And there's a small number where they can get a line of credit, but that's very rare where they can get a line of credit on a purchase, okay? But there's an option in there. All right, thanks. Had a little technical difficulty I had to take care of. All right, so, all right, as long as they meet the terms, you know, they can go ahead and get it. So, like I said, the only issue is, like I said, it has to be the primary resident. And look at this. So they stay in the home. As long as one person is living in there, as long as one of them is still in the home, they can stay in there without having to make a mortgage payment. Here's the big one, benefit to the heirs. You know, I always say involve the heirs from the start, because a lot of times they're going to have misconceptions about a reverse mortgage. They're going to think, oh, you're robbing my parents of their equity. You're going to steal the home. When they die, the bank is going to take over. So, and it also helps that you don't have to tell the story multiple times. So get them involved early. You know, the kids, the heirs, family member, whomever, they help them make decisions. So you want to get them involved with it. Also, any future caregivers, if someone knows they're going to be responsible for taking care of them, if something happens to them, you get them in there as well. Because, you know, you need to let them know it is a growing loan balance, but the biggest thing, this loan is non-recourse. So if the house loses value or it doesn't increase in value, but the loan amount gets bigger than the actual price of the home or the value of the home, they can walk away with it and don't have to pay anything additional. So unlike a regular mortgage where they buy the home, it loses value, and their parents die, and they're in the water, say, by $50,000, then the heirs are responsible for that $50,000. With the reverse mortgage, it's non-recourse, so the insurance will take care of it. But here's the good thing too, though. If there's any remaining equity, it goes to the heirs. So if the home appreciates, they keep all the appreciation. So it's really a no-lose situation for them. If it goes down in value, they walk away. If it goes up in value and it's equity, the bank doesn't share in equity. So if the loan balance is $300,000, the home goes up to $500,000, $300 goes to the loan balance, $200 goes to the heirs. On the other hand, they owe $300,000 on a home, and the home is only worth $200,000. The home sells for $200,000, and the insurance picks up the additional $100,000 balance. So, you know, like I said, once again, unlike a regular loan, none of their other assets can be attached. So if they have life insurance policies or other, you know, assets, those cannot be attached to pay the reverse mortgage. Here, this is a little example, okay? Let's say we get a borrower 62 and they want to buy a home that costs $250,000. They have roughly come with about $132,000. Let's say they want to buy a home $400,000, about $207,000. But if there's, let's say there's 70, they want to buy a $400,000 home, they only have to come with $191,000. So as you see, there's benefits as you get older because you can borrow more money. And I'll leave this up here. Let's take a look at it. And remember, the training slides will be on the website. So if you want to take a look at this metrics, you know, it will be there for you. But like I said, this is a quick little guide just to see where you're at. If you ever talk to someone and they say, hey, and I'm thinking about using a reverse mortgage to buy a home costs $600,000. Oh, if you do a reverse mortgage, you're 65. Instead of coming up with $600,000 cash, you only got to come up with $298,000. And you live the rest of your life in the home without a mortgage payment. All right, let's take this scenario. We got a couple, both 70. The purchase price in the home is $400,000. They want to use a reverse mortgage available funds is $220,000. So at closing, they have to come with $180,000. And let me show you something real quick. Let's say I'm looking to get a reverse mortgage for myself. And my birthday is probably going to be off a little bit because I didn't think of the year before I did it, but I'll say 1945. All right, zip code 95835. Let's say purchase property value is $400,000. And we're doing this for a purchase. And what I'm doing, I'm just showing you this is a system that you would use to buy, when you go ahead and quote someone. Let's say the purchase price is also $400,000. All right, 1234 Main Street, 5835 in Sacramento. A lot of this stuff will auto-populate when you enter the zip code. We got purchase, make sure, okay. So now we come down to the property. So the property is at 6789 West Street. All right, look. All right, let me see what I do. Okay. West Street. For some reason it's 958. Oh, it's Oh, no, let's see. 95835. Okay, there we go. For some reason, I had Alameda County in there. Must know I'm from Oakland, so it knew my county that I grew up in. All right, let's say the home was built in 2010. All right, so we come over here and we're going to make it a fix because we want to give them a fixed rate. So right here, I have to bring $183,541.95 to close. This is how much the reverse mortgage is going to chip in for me. I've got the fixed rate, 5.06. The biggest cost is upfront mortgage insurance. Closing costs, no origination, because we're going to fix, so there's no origination on there. What do I need to get over there? So, there we go. So, this is after everything is said and done. This is what they're going to be looking at for their loan balance. All right, so let me get back to the slide. All right, main thing. The property being purchased must meet FHA standards and flood requirements. So it has to pass the FHA inspection, and if there's flood, if it's in the flood zone, it must have flood insurance. It can be one of the following property types. It can be a single family home or townhouse or HUD approved condo. So you can get a condo with it, but it must be FHA approved. I know a lot of condominiums, they had the HUD designation, but a lot of them fell off because there's certain requirements they have to keep up, occupancy, balance, and things of that nature. They can't have any type of legal action against them. So you have to be careful. You need to make sure that you check it out and make sure it's approved condo. And if you ever want to know if it's an approved condo, just Google HUD approved condos and the link will come up. You enter the name of the condo, or you can even enter the zip code. They tell you every condo in that zip code and tell you if it's approved for FHA or not. And if it's not, there's a process you can go through to get them approved, but it normally takes about 3 months to get it approved. And a lot of times the association has been through the process and they don't want to go through it again. So keep that in mind. So if it's a HUD approved, go for it. If it's not, you definitely want to let them do all the leg work before you try and move ahead or waste your time on it. Ineligible units, co-ops, because they don't actually own the building or own the space. New construction without certificate of occupancy. Here's the key thing. You can get new construction with the reverse mortgage, but you have to make sure you got the certificate of occupancy. Here's an example. They see the new home they want, they start the process, and they see it getting built and everything, but guess what? The county or the city doesn't sign off on it for whatever reason. And if you already start the process, it's not a deal, because whatever reason that unit didn't get approved. So what you do is you get all your paperwork and everything together. You have them go through their counseling, because once again they have to go through counseling. We're going to talk about that a little later. But you get everything ready, but you do not submit an application until you have a certificate of occupancy. Because there's been incidents where people found out after the fact that the house never had a certificate of occupancy, and then once the county finds out, they have to get out of the house until it gets the approval. So, excuse me, no commercial properties, pretty much you can't have a boarding house. Manufactured homes can't be used on a purchase. You can do them on refinance, but not on a purchase. Condo units that are not FHA approved cannot be purchased with a reverse mortgage. You know, like I said, if it's not approved, there's a process that we can work with the developer or condo management association to help them get approved. But like I said, there's a process, and a lot of it is we're going to do a little bit of legwork for it, but then we're going to put it into their hands, and they get this nice fat package that they have to complete. So you do your part, get them there, and then it's up to them to finish it. All right, once again, the youngest homeowner must be 62. The home they're purchasing must be their primary resident. And here's the key. They must occupy it within 60 days of closing. So they can be somewhere else and buying the home here, and they're going to move from their old home into their new home. That's fine. They have to move in there within 60 days. And if they want to keep their old home, that's fine, but they have to move into this home within 60 days. And then there's other things that have to go through approval. Because then if they're going to keep the other home and there's a mortgage on there, then you pretty much have to go through almost like a conventional loan, because they want to make sure they're able to maintain their taxes and insurance on the new home and also maintain the payments and everything on the old home. So there's a process, but it can be done. You know, no other loans can be used. So they can't borrow money for the down payment. They can't get, you know, any type of assistance program. The only loan that can be associated with the home is the HECM. You know, pretty much the difference between the purchase price and the HECM proceeds must be paid in cash or net proceeds from the sale of existing home. So if they're selling the home and they're buying a new home with a reverse mortgage, they can have they can sell the home, go into escrow, then bounce it into the new home. So, you know, pretty much if they're buying it and they're not selling the home, they got to show the cash is there. It has to be seasoned. It has to be seasoned for, I think, 90 days. The money has to be seasoned for at least 90 days. What you need to qualify. I mean, if you're using a cash instead of selling an existing home, the cash must be available 90 days. So you got to have 90 days worth of seasoning. You know, proof that you have the eligible funds at closing. So they're going to need to see 3 months of statements from the checking account, stock. You know, if it's gifts, if all your kids are donating $20,000 to the purchase of your new home, you know, you have to have evidence of the gifts, and those funds have to be sourced through them as well. This is one that I ran into. If they're liquidating retirement assets or they're liquidating stocks or anything like that, you can show them a statement and so they have $1 million worth of stock. Doesn't mean anything to the bank until they liquidate it. And then once they liquidate it, they have to have it transferred into a savings account, and then you have to show the money coming out of the stock into the savings. And it all needs to match up. If there's any difference, you have to, if it's, I forgot how much we had to source, I think, $3,000, and we transferred $190,000 into the account, and they made me source $3,000. So depending on your underwriter, they might have you source it, but liquidate the funds, just got to show that it goes into the new account. And if you're using a existing home, you just got to provide the HUD statement showing that the funds that you got from it. You know, their responsibilities after closing. You know, they're required to pay the property tax and homeowner's insurance. Maintain the condition of the property, just like any other one. They got to maintain it. They can't let it go, you know, unlivable. Living as their primary residence. So, people always say, well, can I get it as an investment property? No, but you can, but then you might have to deal with the federal government. Because this loan is not designed for people trying to supplement their income by getting a reverse mortgage where they don't have to have a mortgage payment and then renting it out to someone and collecting that money. No, it's to help you live in a home without having to make a mortgage payment. So be real clear with that, because I always get people with all these scenarios. Well, what if I get a house and my husband get a house Can we do that? No, it has to be one home. If you're a married couple, then you both have to go on title together. The only way you can get two homes like that, divorce, give you a divorce decree, they each can buy a home. All right, we talked about this before. We're going to talk about later things. You have to be the consultant because you have to make sure that they understand the scenario. You know, review the individual in their individual scenario with them. And with us, and I'm writing this from a position where how we can help other lenders. This is how I sell it to realtors. When I talk to them, I'm letting them know I'm going to be your consultant. If you have buyers that want to use a reverse mortgage, that's fine. I'm going to make it easy for you. I'm going to take care of everything for you. I'm going to thoroughly explain the program. I'm going to give them their loan options, the costs involved, and what's required of you, both the buyer and the realtor. And you know, the two different realtors I've worked with, they came in like, oh, I don't know about this reverse mortgage. Is it going to take me 60, 90 days to close the loan? I heard a lot of terrible things about it. Both of them, after the process was over, they said it was smoother than a conventional loan. You know, initially they had their reservations, but they both were sold, and we're looking to do more deals together. You know, the process. You got to go through counseling. So before applying for a reverse mortgage, they must go through a counseling with an independent counselor through HUD. This is done over the phone. It's pretty much to make sure that they understand the process, they understand they're getting a loan. Because some people say, hey, I didn't know this was a loan. I didn't know I had to pay it back. You know, it'd be nice if somebody gave you $20,000 or $20,000, let you live in the house and you don't have to pay it back. But yes, you have to pay it back. So once you go through counseling and you get their application, I should have put another step in between application and processing. We have to get a case number from FHA. So we get a case number from FHA, then we can go ahead and put them in processing. And once we get them in processing, then we can order the appraisal, we can order credit reports, all of that. Remember, California, there's a 7-day window where we can't do anything. So during that 7 days after counseling, it's pretty much it's the period where you're going to collect all your steps. Okay, if you're going to need, okay, we can't order credit or anything like that, but you're going to ask those questions up front. You're going to ask them what type of debt they have. You're going to ask them, you know, have you filed bankruptcy? You're going to ask them all these questions because these are things that are going to come up. And so you want to get them in advance. You want to get copies of their bank statements. You know, since this is a purchase, you need to make 3 months of their bank statements. You need to have the Social Security award letter if they're getting Social Security. And if they have a job, you need to have pay stubs. If they get other type pension, you need a copy of their pension. So you want to get all those things together during that 7 days. That way, as soon as the 8th day hit, you can order your appraisal, you can order your credit report and get it going. Closing typically takes 30, 45 days. I'm trying to do one in 25 days. Just submitted it, waited my 7 days. The only thing that might not let me make that is the appraisal company. It's taking them a week to set up an appraisal. So the appraisal is not until the 10th, which is Thursday. We submitted it right around the end of, what month are we? We're in September, right? We're in September. We submitted the end of August. So it's probably going to be a 30-day close. But, you know, just did the couple purchases I did, they came in at 45. I told the agents up front about 45 days, but they were pushing for that 30-day close like they all do. But we beat it within 45 days. And what's going to happen now with these new changes that are coming up in the mortgage, October 1st, your average close is going to be 45 to 60 days now anyway with all these new requirements. But we've already went through the growing pains, so as reverse mortgage professionals, we know it and we're able to get through it. So I think it's not going to hit us. We've already been hit with our changes with the financial assessment. So now everybody doing conventional mortgages, they're going to get hit October 1st. Repayment. The loan becomes due when the borrower sells the home, the property is no longer the principal residence of at least one borrower. So if the borrower goes into assisted livings or something like that, or they have to move in with family members because they can no longer function on their own, then the loan has to be paid back. The last surviving borrower on title passes away or vacates the home for more than 12 months due to health or other reasons. So they get sick and they have to go into a home for a while, but after 9 months they come back home. Guess what? The clock that it started, it stops. So they're back in the home so they can live in there until they have to move out. Here's where it gets tricky right here. If they fail to pay their property tax and or homeowners insurance, and all attempts to rectify it has been exhausted, bottom line, they're going to foreclose before the county forecloses on you due to taxes. They have an investment in this property. So if the taxes hasn't been paid in a number of years, and the house is in the process of getting foreclosed by the government, guess what? They're going to foreclose before that. Because if the government foreclosed, they're going to lose everything. They're not going to get paid off of it. So they will work with you on the property taxes, help you try and set up plans, work with you to tell you how to set it up with the county to make sure the taxes are paid. Or the property is in disarray or disrepair, and the borrower refuses or is unable to repair the property. If the property is no longer livable and it's just they turn to a hoarder, in the house, then the bank can come in there. Just like any other mortgage, there's a clause in every deed that states the home must be kept up. Okay, I have a question. Give me one moment. That I don't know. Any tax issues, like in a little short sale? That I don't know. It all depends on what their situation is. But on a short sale, normally they're pretty much in a short sale scenario, the IRS say, okay, hey, you owe $300,000, but you only paid $200 when you sold it, so you pretty much got $100,000. Even though they didn't get the $100,000, there can be tax issues behind it. With reverse mortgage, once again, is no on a regular transaction, because I hope you're not talking about the foreclosed, because that's totally different. But if they die and the house to lose value, like I said, it's non-recourse. The FHA insurance is going to pay it, so that takes care of it. So it's avoiding the issue that they normally can have. And Frank, I'm sorry, did I answer your question, Frank? Because were you talking about the foreclosure issue or just the standard is underwater? But if it's underwater, no, there's no tax consequences. And if it's a foreclosure, normally they're going to sell it and get their money anyway. Because it's not like they're selling it because of the market drop or anything like that. They're selling it because they didn't pay their taxes. Usually the last surviving borrower or the estate sells the home to repay the loan. The loan can be repaid in cash from any source, such as other assets, proceeds from life insurance, or loan refinance. So if a family member wants to buy it, they can go ahead and refinance it in their own name and get it. And if they have life insurance, and like I said, a lot of times I will tell people, you might want to talk to a person about life insurance to protect the asset if you want to be able to pass it on to your heirs. All right, thanks. Okay, Frank, glad I was able to answer that for you. Once again, no debt is passed along to the heirs. Non-recourse, really big. A lot of people now with their estate planning, they're going with this. A lot of people with Medicaid, because there's certain issues with assets they can have, they're going with this because if there's a reverse mortgage, the government can't take the house because there's a lien on the home and the reverse mortgage is going to sell the home. So They don't have to worry about those assets being attached. Another thing, I have to look again, but I think it's 95% of the appraised value. That's what the heirs can buy the home for. Is either 90 or 95%. I'll give you that information in future trainings. All right, like I said, once the loan is repaid, any remaining equity belongs to you or your heirs. So if I decide, hey, I'm going to sell the home and I made a $100,000 profit, then the $100,000 is mine. I don't share it with the bank. You know, the biggest thing I get asked when I'm talking to realtors, why should we go with ERS? We're a one-stop shop. We do everything here for them. You know, when I'm talking to other realtors, I can't tell them, hey, we got realtors, we can sell it, we can do that for you. But when I'm talking to realtors about it, then I'm explaining to them the benefits of, the benefits of the program, how we're going to handle everything on our end for them. All they have to do is handle the real estate part of it. We're going to do everything else. And a lot of times if you need us to work with your client more, we're going to do that for you. And, I have a person here who I did one with. Michael, how did the transact, how was it for you?
It went pretty smooth, and you were a lot of help.
Yeah, so I don't know if you can hear him, but he said it went pretty smooth and how we helped him through the process. We have a special department. We specialize in reverse mortgages. We do other type of mortgages, but reverse is our key. I do other mortgages because I know how to do them, but I'm an expert in reverse. If I'm doing a conventional mortgage, I'm calling central process every other day asking them questions just because I don't do it on a regular basis. A lot of times to be an expert in something, you have to do that and concentrate on that. So I spend my time understanding the reverse market and make sure I'm specialized in that. Once again, we match the customer to the right product and empower them to be financially independent. We don't match us to the product. We don't say, okay, right now the margin, I can get them a 2.75 margin. I can make an extra $3,000, $4,000. We don't do that. We're gonna go with a low margin because guess what? If I give them a reverse mortgage and they talk to someone after the fact and they say, oh, he gave me a 2.75 margin, and I hope you all know when I'm talking about margin. If I get them a 2.75 margin, they say, oh, well, God, they could have gave you a 2.37, a 2.5. Why didn't they give you that? I get deals all the time. People said, oh yeah, I'm working with a person right now. They're doing a reverse mortgage for me. My margin is 3%. I'm like, 3%? Wow. I said, that broker is really taking care of themselves. What do you mean? The higher the margin is the higher the profit to them. Perfect example. If I do a 2.25 margin and they do a 3%, they're making almost 1.75% more off that loan. And off a $300,000 loan, that's a pretty nice penny. But once again, they're not taking care of the customer. They can be robbing the customer of proceeds they can get by giving them a proper margin. So we're going to do that for them. And that's how we separate ourselves from other professionals. We're taking care of the customers. Because to me, a happy customer is a customer that's going to refer you. When they talk about you, they talk about the process, they're going to talk about how you made it so easy and convenient for them. They're not going to deal with anybody else. They're going to call you at 7 o'clock in the morning asking you questions. Yeah, and Michael knows what I'm talking about. So we had a special client, great lady. Michael is giving me her keys today because she hurt herself. So she didn't feel like getting her, doing everything today. So Michael's going to give me the keys and I'm going to deliver them to her tomorrow. So like I said, we're a one-stop shop. We're going to take care of all that for you. All right, so that is the presentation. I'm going for more concise information instead of, trying to spread this out over 2 hours. Most of the people don't have the attention span to do that. We're all busy professionals. I feel we touched on everything you need to know about a HECM for purchase. I mean, I will have to sit up here for 8 hours to give you every minor detail. So if you have a deal, you want to get a scenario, give me a call, 916-549-3506. There's my email address. And, I can walk you through your scenarios. And, any wild scenario you have, doesn't matter. I will help you through the process. I'm here and other professionals here, we're here to help you. We want you to succeed. Like I said, we want you to be able to talk to a borrower. And like one of the deals we did, we were selling their home for them. And they were going to walk away with almost $300,000 profit. And they were about to buy a home for, I think it was $200,000. So they were going to pay cash. And so we said, wait, hold up, actually, let me give you this slide. I got a slide that shows that one. Give me one moment. We told them, I said, why put all your money into that when you can do a reverse mortgage? So give me one moment. All right, give me one. I'm gonna show you this a different scenario. Oh, this is my favorite. I love this one right here. And this is just some more information. So, this is some of the misconceptions about a reverse mortgage. Lender does not take ownership of the home. Lender is not sharing appreciation. Poor credit does not disqualify them. Resident does not have to be debt free. Like I said, they can't have a mortgage on there. Social Security and Medicare are not at risk, but Medi-Cal can be affected. So we have to tailor a program to fit them. And like I said, a lot of the people who are working with people on Medi-Cal, they're coming to the whole process of the reverse mortgage. Non-recourse. One can never owe more than the value of the home at repayment. Other assets will never be invaded. All right, this is my favorite one. A reverse mortgage is not just an option of last resort. Should be considered in the overall planning, financial planning. Because here's the thing. The largest reverse mortgage in history was for $18 million on a home valued at $54 million. Soak that in. $54 million home took out a reverse mortgage for $18 million. And the reason he probably did that is, okay, hey, you know what? I want to get some money to my heirs. I want to take care of some other stuff. Why take out a regular mortgage and make a mortgage payment? I don't even want to know what the terms is on an $18 million loan. Don't even want to know. I just want the 18 million. Or no way, I want the commission off of 18 million. I'd be happy with that. I don't have to have the whole 18 million. I'd take commission off of it. But, their home was valued at 54 million. And they did 18 million, they took $18 million out of a reverse mortgage. So it's not a last resort. So when people think, oh, reverse mortgage is only for people who don't have money or this and that, they don't know. Because like I said, most people who are getting reverse mortgages are high net worth individuals because they see the benefit of it, okay? Have a home, it's just an asset. At that point, it's no longer, all the touchy feelings are gone now because the kids are gone and everything, so it's an asset. So if I have an asset and I can pull money out of it while having to make payments on it, why not? If I want to give my kids money, here, why not give it to them while I'm living and not wait till I'm deceased and give it to them? So, so it's not a last resort. All right, we got any questions? I know we went through a lot of information. Let me see if we have any questions up in there. Or they might have asked something earlier, but oh, I know you was here for a reason, Michael. Thank you. All right, okay. Here we go. you know, as you get, I'm getting closer to age for reverse mortgage, so I guess I'm starting to lose a little bit of my thing. All right, here we go. Bob and Sally, they're selling their home for $230,000. Okay, they want to pay cash for a new home, and that's going to lead them $135,000 to invest and live on, or they can use a reverse mortgage. If they use a reverse mortgage, they only got to come to closing with $55,000, and actually it's probably a little less than that now. So it probably got to come a little less than that. But in this scenario, instead of having $135,000, they have almost $180,000. So almost at, what's the difference on that, Mike? What's 180 minus 50 grand? Thank you. So it's an extra $50,000 they have to live on versus if they pay cash for the home. So that $50,000, they can go out there and earn interest on it. They can go out and spend that on life insurance. They can go out there and buy, you know, a life insurance policy for $200,000. So they sell the house, they pass away, the heirs get $200,000 versus $100,000 for the home. So this is what I mean. It gives them options, and it's a financial planning tool. And once again, it's not a last resort. All right, so do we have any questions out there? Or scenarios you want to talk about?
Is there benefits to purchasing, let's say, using the equity?
Okay. Had a question, is there benefits to purchasing the property using the equity? Let's take the purchase out. Let's say you have a home worth $500,000, okay? You want to take out a reverse mortgage. Let's say you're able to pull out, just round numbers, $250,000 from your home, okay? You own it free and clear, you take out a reverse mortgage for $250,000. You can go out there and buy other property with that. You can buy the new property tax-free, or how about this? How about you give it to your children and let them buy their first home? Or pay off debt for your grandkids, or whatever you want to do with it. It's tax-free money. So you can do what you want to do with it. So you can't, a lot of people do go out there. Had one guy, he took it out to go buy them a vacation home. They wanted to buy a vacation home, I think it was in Alabama, on some river in Alabama. They wanted to buy a vacation home, so he took out a reverse mortgage and paid cash for the home. And then the summer home that he bought, or vacation home, he rents that out. So he's making money from renting his home out and still able to enjoy it when he wants to enjoy it. So you can start a business with this money, whatever you want to do with it. There's no requirements for it. Any other questions? I think you're going to become a client shortly. I think, I see the wheels turning. So, all right. So, that is the reverse mortgage for purchase. And like I said, any loan scenarios, give me a call and I can run them for you. All right, so if there's no other questions, that's going to conclude our training for tonight. I'd like to show you one more thing. And actually, while I'm in here, I'll show you this scenario. I'll show you the amortization of how long it takes for them to deplete their equity. I'm going to show you how long it would take before the home is upside down. All right, where are you at? Reverse vision sometimes goes super slow, so there we go. Okay, home is valued at $400,000, okay? All right, so this is how the loan balance will grow with the interest and everything every year. So let's say the home did not increase in value. Before anything, they're looking at about between 8 and 9 years before the home is upside down. But if it appreciates at 4%, we're looking at 24 years before there's no equity in the home. So you live in a home for 24 years, and we all know if you buy a home for $400,000, 30 years, the home costs $400,000, but you're at the end of the term, you're paying about $700,000 for the home with the interest and everything. So as you see, those payments they would have been making on the $400,000 purchase, like say they can invest them, they can do whatever they want to do, but they still get to maintain their home, live in their home. So you see it, this is how the equity goes. And you see, yeah, it is going down because the loan balance is going up. So, you know, like I said, but let's say it didn't appreciate at all. You know, I like to show you this example as well. Let's say it appreciate only at 2%. You know, because, Mike, what's the average appreciation right now?
You mean over yearly?
Yes.
I would say it's probably about 2%. I don't think it's much more than that.
About 2%. Then it depends on the area and everything. So a good average 2%. Let's say appreciate 2%. You still got 13 years before your equity is depleted without making one mortgage payment. And guess what? Wow. In 24 years, you owe $1 million. And the home is only worth $643,000. What's going to happen to you? You walk away. You walk away from it. But you walking away, there's no problem with it. They can't. It's non-recourse. And guess what? The bank don't care. They're going to sell the home for $643,000, and then guess what? They're going to go to FHA and get a check for another $400,000 because it's FHA insured. Non-recourse. If this is a standard thing, let's say this is a regular loan, and you got underwater. Short sale, and then they're going to attach assets. They can go after your assets if they're going to approve a short sale. Because short sales are getting harder and harder to get approved nowadays because the banks say, hold up. The value is back up now. We didn't tell you to take out that line of credit when the value was high and go out buy those speedboats and everything. We didn't tell you to do that. And now you want to walk away? No. You're going to pay this. If you're going to do a short sale, guess what? We're going to tax everything else you got. So, now with this, because it's non-recourse. All right. That concludes it. Like I said again, I'd like to thank everyone for joining us today. And like I said, in your loan scenario questions, let me put my information back up there again. 916-549-3506, or feel free to email me. All right, that concludes the training for this evening. I'd like to thank everyone for joining us. Next week, we're going to talk about a little bit more about the reverse mortgage. We're going to talk about different ways to sell it, a way to market it. So please join us again next week, and we have plenty of seats available here at corporate office. Come in and be part of the studio audience. Thanks, and have a great night.